Hello, I'm Greg Bonnell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. We got a great show for you today. Coming up, we're going to hear the bull and bear case for Disney. Our trader debaters standing by on that one. Also going to take a closer look at the North American indices following the strong post-election rally. Try to assess if there's still some room to run. Plus, we'll take a look at a China large cap ETF following that country's recent stimulus package. Doesn't seem to be impressing investors. You're watching TD Active Trader Live. All right, let's take a closer look at the U.S. markets. We'll start with a heat map, a nice picture of what's happening out there. We have obviously been hitting new highs on a lot of excitement out there, including the election, but also the AI trade being rekindled. There's NVIDIA, pretty much the poster child for the AI trade over the past year and a half, 2 years. It is up about 2% outside the open. Across the rest of the board, it is a bit mixed. We got some green on the screen from some of their tech names, but it's nothing too dramatic, and a little bit of weakness in some of the healthcare stocks and Tesla. Now, Tesla's been on a nice run since the election, giving just a little bit of it back today, down about 2.5%. We got some interesting moves, obviously, in the S&P 500 since we had the show last week. Since we last spoke, there was an election. There was a Fed rate decision. A lot has happened. We have had the S&P 500 hitting new highs in the wake of all that. Today, we got a bit of movement off the top. Just at the beginning of the trading hour, you can see we're modestly higher. Markets aren't too strong today. They're a bit mixed. I can see right now on my screen over there, the Dow down just a little bit, the S&P 500 up just a little bit. Some stock-specific names, because of course we're still in the thick of earnings season. Let's take a look at the New York listing for Shopify. Of course, it's a Canadian company coming out with its earnings report this morning. Now you can see from the pre-market action and that big jump higher and the volume we're seeing right at the opening of trade today for the first half an hour, that investors are impressed by what they saw from Shopify. Operating income more than doubling, a revenue beat. Focus here, we get back to the AI theme. They've been focusing on employing their AI-powered tools that is attracting more merchants to their e-commerce services, and their forecast is pretty strong as well. It seems to be pleasing the street when you put it all together. The AI assistant, if you're familiar with the Shopify platform, they rolled it out to more of their customers in June. AI has been, to some eyes, a disappointment, right? Because people say, like, well, it's supposed to be a revolution and everything. But we're starting to see companies say, hey, you know what? It just makes us a little more efficient. Customer data behavior, executing on certain things, sales reports, seems to be making the street happy for this one. Different kind of company, but I love watching the home improvement chains because it tells you about how the consumer is feeling, right? Home Depot coming out with their quarterly earnings, revenue beating estimates. Sales are starting to get a bit of a boost from some acquisitions they made, some hurricane-related repairs, but overall the company's saying consumers are coming back in the store. It's been a pretty tough couple of years with the inflationary pressures. A lot of us, including me, during the pandemic, you're locked at home, what are you gonna do? You do home improvement. I've been taking a breather over the past little while. Maybe I need to step back in. I am told that at home. I need to step back into the home improvement. You put all together, you got Home Depot up a little modestly at the opening. And that's your market update. All right, joining us now for more technical take and all the recent market highs. It's been a very interesting 7 days since we last met. Gentlemen, here in a min, and Jason Natick from our direct investing educational team. Always great to have you guys here. We got another show. We're just getting started. The market action. We got to dig in there. What a week it has been here, and you're taking a closer look at the Dow.
Yeah, let's look at the Dow. The Trump trade is definitely still alive, from the election that's just unfolded. So let's look at the Dow, and we'll also look at the NASDAQ just after it. So pulling up the Dow Jones, the big news is, of course, we breached that 44,000 level. First time in history the Dow's done that. But what's interesting is just coming into that now, if we just look at it a bit closer, we had this gap up form over here. Now, technically, whenever you see a gap up, those gaps tend to get filled. There's a long way to go, but we could see if it keeps going to these levels. We're seeing a candlestick forming. It looks like it's almost forming like a hanging man, which usually tells us at the tops we might see a bit of a reversal at these levels. So we'll see how that shakes out. But it's obviously in a very strong upward channel right now, the Dow. And based on its current trajectory, we'll see how if there's indeed going to be a Santa Claus rally on the cards there. That's going to happen. Or I should say Trump rally in this case, whichever you want to call it. Let's look at the NASDAQ Composite Technology Index as well. We haven't seen as much love. I mean, we've seen the NASDAQ had a little bit of a shaky start throughout the year. Again, it's forming these tops. We've had a gap up again, so we'll see if it pulls back. There's quite a bit if it is going to pull back, but it just hasn't played as much as the Dow or the S&P 500. So the techs are not getting that much love, or there's a few big weights that are really pulling the techs up, but broad market participation is a bit weaker on that end. And the last thing we wanted to just check out for today was we talk about risk on and risk off environments in terms of the equities and what's going on. And typically on a risk off environment, you see utilities take a surge, money flowing into utilities. We did see utilities come off of this sort of downward channel. They found sort of a support. We're looking at XLU and it's kind of rebounding, but it's still below its averages there. So we'll just see, is the risk on play still going to happen? Are we going to see money flow staying in that, or are we going to see it coming back? And that's going to be dependent on a lot of the macro reporting that's going to be coming out in the next couple of weeks there. So that's just a quick look at what we're seeing so far with overall broad markets.
All right, Jason, China, world's second largest economy, came with a whole host of stimulus measures. Investors seem underwhelmed. You're taking a look at a iShares China large cap ETF.
Yeah, we're looking at FXI, so looking at the largest cap Chinese companies. China in general is largely in the political crosshair of our neighbors to the south, so it's kind of interesting to see kind of how this plays out. China seems to be suffering from the 3 Ds. We're talking debt, deflation, and demographics. So that is on a whole is impacting kind of maybe sentiment in the market. But as you mentioned, there's been quite a large stimulus. $1.4 trillion has been introduced by the Chinese government to help kind of settle some of the kind of more localized, not formal debt structure that they've got. So they're trying to bring some stability there, and it may have had actually a different impact than it was intended on the markets. So let's take a look at the chart. We've got FXI up on the chart. We can see even on a broader scale where they're trading well off the highs, especially since the election. Thinking about those elections, we've got other things that we've got at play, and even as we look at a shorter term trade, we can definitely see a big pullback in those large cap stocks. So the market is obviously forward looking. Everyone's got ideas of what the tariffs are going to look like, but we'll really be looking to see when we got some public statements from the new administration to see how that's going to play out. This is this stimulus is even potentially having negative impacts on crude prices globally as well, yeah. Since you're getting less demand from the Chinese market. They don't think the stimulus package that's been introduced is going to have that spur that they was hoped for.
All right, great stuff, gentlemen. Thanks for that. If you have a question for us from the home audience for this team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan this QR code at the bottom left-hand side of your screen. You're also going to find great resources under the Learn More tab to help enhance your trading skills and amplify your knowledge. All right, it's time for the trading and debating. This week, the stock on the radar is Disney. We got shares up about 10% year to date. Company set to report quarterly earnings on Thursday. Before we get to this debate, gentlemen, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your risk tolerance. Make sure you do your own due diligence before engaging in trading. Okay, let's get back to the stock of the hour. It is Disney. What made you guys pick this stock to debate? Something about vacations and cruises?
Yeah, something about that. Just very recently, I got to experience firsthand of what exactly the Disney experience is on a cruise. And it was just something to behold. It's something different. Not that I've cruised a whole lot with different carriers, but they do it differently, speaking to a lot of those fellow cruisers as well. They said Disney's unparalleled in the experience. So I thought, hey, you know what? And plus, they got a big share of my wallet. Not only did I fork out, but once I was on board,
the cruise was not inexpensive?
No.
Yes.
To say the least. So there's a lot to be said on how they're monetizing the onboard experience as well. So our focus is not going to be just the cruises. We'll look at it as a broader scope as the business as a whole, though.
Yeah, what intrigues you about the name, Jason?
Just the integration into everyday life, right? Whether or not we're talking about the lead up to Christmas time with presents for the little ones, or we're talking about watching ESPN, or just some of the streamers are watching some of the big holiday movies or something like that. It's one of those interesting companies that's got a lot of reach.
Yeah, they capture a lot. They capture the Star Wars nerds as well, and don't get offended if you like I am a Star Wars nerd going way back as well, so I proudly wear the nerd label. We're gonna get some time on the clock now to debate this name. They gave me a bell on the show. I ring it when your time is up. I think I've been fairly fair with the bell. I've not been going crazy, but it's tempting. I like the bell. So we got the time on the clock. You each have 2.5 minutes to argue the bear and bull case for Disney. You guys drew from a hat ahead of time, and Jason, you got the bear case. So why don't you kick things off?
Yeah, the bear's stepping up to the plate here, absolutely. So you mentioned Disney's up for the year to date, but if we look at some of the close comparables, it's down compared. It's trailing the S&P in terms of what it's brought to the table. S&P's up almost 35%. Disney's is what'd you say, around 10%. So we've got a comparison there. Maybe your money is better spent elsewhere. And even if we look at an industry tracking ETF, which is up nearly 40% compared to Disney. So we've got other opportunities to make some plays. And when we're thinking about making bearish arguments, it's not always black and white. It's shades of gray. It's oftentimes about timing the market, and that's not always easy, but let's kind of dive into it a little bit. Some of the big revenue drivers for Disney, we've already talked about some of the streaming opportunities. Yes, the streamers have finally, after a long-awaited profitability, they did kind of surprisingly make profits in Q3. Interesting to see how that plays out later this week when earnings come, to see if that was a blip on the radar or if that's going to continue. Their CEO, Bob Iger, did mention that they've lost up to as much as $4 billion. That's billion with a B on streaming content. So that's not a small chunk of change. And then speaking to Bob Iger, they've just announced succession plans. We all know how smoothly that went the last time that he decided he wanted to step away and then put himself back in the chair. So I think all eyes in the market will be looking for some firm expectations of what they can expect. All right, enough about the company. Let's jump in and take a look at the chart here. So if we think after COVID, Disney made a high. Well, let's put a line up on the chart. We're talking March of 2021, and if we bring the trade out to a present day, we can see Disney over that time period is down just north of 50%. So there's money that's, if even a long-term holder of the company, there's money left on the table. And thinking about more near-term pricing, yes, there's been some peaks, but there's been some significant resistance. We've noticed in the company around 125. They've not been able to cross over that threshold. So we've been able to see that. Yes, it's been trading in a pretty tight band from that 125 down to probably around $80. But let's look in more nearer terms so we can start to identify kind of that timing of the trade. So if I look at more of a near-term chart, sure, Disney's had a little bit of a gap up, but what we're seeing, if I take a look at the RSI that I've got down below where we're showing overbought and oversold, Disney has popped over the overbought. It's retreated below back into the center band a couple different times. So there's an opportunity.
I've been trying to be sneaky with the bell before my tell. I was like, move my hand. What am I warning these guys for? Sneak it in. All right, so there we go. The bear, the bull.
All right, the bull's frothing at the mouth. Disney, the house of mouse. What can be said? So let me start by saying this is the largest entertainment company in the world. They include 12 destination theme parks. They have a plethora of different subsidiaries that they built out of, an unmatched content library. And this all holds a special place in the hearts of people around the globe. That's what I will say this. It also all comes together, as you mentioned, Jay, to create that Disney magic that we've known, the magical kingdom. Just some of the numbers that we want to look at. So Jay mentioned three streams that they earn from: experiences, which is the parks, the cruise line businesses, the entertainment, and then of course we have the sports. So let's look at some of the numbers. Average analyst price targets on this stock is sitting at about 110, 111. That's a 10% upside from the current price. You mentioned the highs at 125 there. That's 25% if it can reach that resistance level. On the CAGR level, if we look at the fundamentals and go down, they're expected to do 14.21% CAGR over the next 3 to 5 years. They've had a 20-year history in high single digits of CAGR already. So that's just growth.
Break down CAGR for our audience, quick.
Compounded annual growth is what we're talking about, and that's just the synonym for it. And then when we talk about the one-year EPS forecast, that's 32%. So there's a lot of growth stories that are happening. Put that with the wide moat that they have. They have intellectual property rights like no one else does. Things like Duckburg to a galaxy far, far away, and some of your favorite characters, Spider-Man, Marvels. you get the rest of it. So there are a clear path to profitability. Let's go into the charts now, though, and let's look at what the price action is showing. So just bring up the charts. We're on a daily chart right now. Yes, it's no denying that it came off of this strong downtrend, but we just see this inflection point. We see demand shore up at this $83 level, and kind of that support between that 85 to 90, where we saw buyers stepping back in, where they're seeing value. And we're now in this upward channel from what it looks like. So we're back, we've turned a corner here, hit those lows. The other thing I just want to point out to our viewers is we had a gap down. We formed this island. There was a gap down event that happened, and we know that gaps get filled. So the next zone, if it could get filled, is looking at between that 111 to 115 zone. So if you can push through there, that's still about a 10 or 12% upside on a trade you're looking at over the next couple of months. The indicators are also right in our favor. RSI is just hitting that overbought level, but that's because it's in that uptrend anyways. Until it clearly signals down, we're not really seeing anything to be concerned about. And MACD, the moving average convergence divergence, is always also on a positive bender there. So again, we're seeing some good sort of support happening in the way.
I give you 3 extra seconds. I jumped in there and made you give me a definition, but all right. So we've heard the bear, we've heard the bull. You showed us price action. Here an appeal to the heartstrings of old memories. Go at it, boys. You get a chance to counter each now for 3 minutes.
Well, let's tug at those heartstrings maybe a little bit more, right?
All right, let's do it.
Disney is heavily reliant on sometimes antiquated revenue streams, right? It's those linear cable models. It's they're trying to shift to direct to consumer. We're even thinking about seats and bums in cinemas. I don't know if they'll be able to recreate kind of that glory past that they've had. They might not be the new belle of the ball, if you will.
Jay, I'll say one thing. You actually made my argument for me. You said at the start that they integrated you, and it's the ubiquitous in households, so they're covering everything. The big screen is not going to go away. But they also have direct to consumer. You mentioned that they've made that shift. ESPN, which is the biggest sports network you can think of, they're on a trajectory to go direct to consumer by 2026. They're going to be on Disney Plus in the interim there just to fill that gap, but they're moving towards that. The other thing is you have such a wide moat with this business with theme parks. No one else is going to do that. Netflix is a competitor in the streaming segment only. Where are you going to go if you need to go to theme parks? You're going to go to Disney usually. With cruise lines, Disney's another choice. So they got that diversified experiences that no one else can touch. And the barrier to entry is even impossible. Like and the intellectual property, you're not going to create a Mickey Mouse or another character in this lifetime.
They're sure trying. And speaking of Netflix, they're trying to kind of upset the apple cart by actually introducing live TV into their streaming services. So they're again getting out in front of Disney
Jay, you're
Plus.
a sports guy, right? You're a sports guy. So when Aaron starts talking about ESPN and direct-to-consumer and stuff like that, and obviously that's been a bumpy ride. I mean, from a sports guy's perspective, what's going on with Disney?
Well, they're bumping up against other competitors with deep pockets when you're talking about the Googles and the Amazons of the world. So Disney doesn't get a free ride here. Sure, they may have a bit of a head start, but money counts. And NFL, NBA, NHL, they're all taking it from their competitors as well. So it's not as if they're going to get anything for free. And those experiences, you've just been on a cruise. You know how Disney can get their hands in their pocket. That alone, the growth of their experiences model has led to a pullback in their stock price after the last earnings period. There wasn't a big enough increase in experiences due to kind of offset those consumer costs, but also costs directly to Disney itself to put on those experiences.
You need to spend money to make money. That's what I'll say. That capex, right? Like they've got a pipeline of investments that they made. They have a $14 billion free cash flow. $6 billion is being set aside for capex to build out the theme parks. They have like 5 cruise ships in the pipelines. One just released this year, the Disney Treasure, that's coming out. So this is all going to generate revenue again and growth story there. And what I will say is, listen, if you don't look at the fundamental backdrop of the story, you got to look at the price action. You look on the daily, you look on the monthly. This is on a reversal right now to the upside. We're seeing a bit of upside. We're going to test those new price levels there. And I mean, you would, like, if you're looking, and possibly if there's anyone who's even shorting this stock, you might even see a bit of a short squeeze that's going to buoy the stock up a little bit more.
Let's take a look at the price action in the short term as well. You've said it a couple times already in today's session, all gaps get filled in. Well, what do we have? Recently, we just had a recent gap up. And if I look at on my chart here, we are trading towards the top of the expected range in the Bollinger. Sometimes that's signifying we could see a decrease in the price as well.
All right, ding that into your corners. Nice work there, gentlemen. All right, so now that we've run down the arguments on the bear and the bull side, we're going to explain that if someone took these positions, which you drew out of a hat, how they would play it through options. Where are we going to start? We started with Jay, so we'll start bearish.
Sure, let's go bear. So as we know, we've got earnings that are coming up, and if we're playing a bear, what I'm thinking about for my trade, especially when we've got the unknowns of the earnings, that's where volatility is starting to increase, right? I want to make sure that I can kind of limit my exposure. In this case, the trade that I settled on was a long put. Okay, with a long put, it's right now with that the increased volatility, it could come with increased premiums, but I know that I can upfront manage my max loss. And because I'm long, I'm probably going to take on a little bit extra time, so I get a little bit extra time to be right. So let's jump in here and we'll take a look at the trade. So I'm going to jump ourselves over into the option chain. We know that earnings are coming up this week, but I'm going to take out a little bit extra time on this trade. So when we're thinking about going long with options, we need the stock to move in the direction that we are taking in our trade. So with that being said, I'm usually going to take on higher probability trades because I'm going to see more impact of the stock's movement in the price of the option as well. So we're going to go in here. Let's say I've got a delta trade of around 41 here. So if we're thinking towards the end of the month, we've got that $100 price level that we've talked a little bit around. If we get that gap being filled in, if we go ahead and buy those $99 puts, we can get that right on there. Now that cost right there, it's $3.20 across one contract. We're talking $320 plus commission. If that ends up being too rich for your blood, then you can think about legging yourself into like a bear put spread. So we're talking like a debit spread. So therefore we're selling further out of the money options to try and generate a little premium to make it a little cheaper. Yeah. Still taking that bearish direction, but making that kind of offset in my pocketbook just a little less. There's just less kind of downside potential for me in this. So maybe we go $5 down from there, down to 94. If I go ahead and add that into my trade, what we're left with is a debit of less than $2 with still that same downside protection.
All right, so there's a potential way to play it as a bull, as a bear, potential way to play it as a bull.
All right, so same sort of idea as well. I'm looking for an upward move on the price with earnings coming up there. Just looking based on the charts where we were seeing previous resistance and the gap being filled. We're looking at that 110 to 111 zone. Now, the trade that I'm going to put on is called a butterfly, a long butterfly. So why am I doing the butterfly? Well, it's all to bring my costs down, because if the trade doesn't work down, I want to be able to still nurse my losses there. So just bringing up the options chain, if we go in here, the butterfly setup is essentially we're going to buy a call, go long a call, and then we're going to sell 2 out of the money and then buy another one further out to just protect ourselves. So here's the trade. We're going to do the 100, which is pretty much on the nose at the money right now. We'll pick that. We're going out to the December time frame here, just giving us about just over a month there. And then we're going to sell the 110, which is around that sort of zone that we're eyeing there to fill the gap. I'm going to click on this to sell that one, and then we're going to just line it up with the same spread and buy the 120. Now, the one difference, what makes the butterfly, is we're going to just increase this to 2 contracts. So this is what makes the trade. So the trade's sitting at about $2.50 roughly there. So that's my downside. So I'm spending $250 for a single contract. That's my risk. So if Disney goes the other way, below 100, that's when we end up losing. But if it does climb, then we could actually see some potential gains. Now, the interesting with a butterfly, though, it's almost like you're trying to hit a bullseye, Greg. Like you want the stock to go up, but then you don't want it to go past the 110 level because then you have diminishing returns. So this is a trade where it's kind of difficult to hit that bullseye. So the key is just managing it a bit early. I'm maybe going to set a profit target, let's say, 25, 50%. So you're not waiting to have it hit the 110 or even go past it where you start losing there. So this is what we'd be looking at in setting up the trade there in a bullish run.
Interesting stuff, gentlemen. Thanks for laying out the bull and the bear sides for Disney. Just a reminder to our viewers that this debate was for educational purposes, does not reflect our personal opinions about the stock. Now, before we move on, I want to ask you, Jason, about the risk profile feature that you were using during the debate. How did you set that up?
Right, so we've talked about kind of risk reward, profit and loss scenarios, and one of the tools on the platform to kind of really help lay it out for you, and if you're a visual learner like me, is to use the risk profile. So let's jump back into the platform and I can show it off for you. So we've got my trade that I had been talking about, my debit put spread. If notice here in the top right hand corner of the order ticket itself, there's a little analyze toggle. If I go ahead and flip that on, I now have the opportunity to create a planned position. If I go ahead and click the Analyze button now, what's happened is a planned position is now in my account. If I now go over to the Analyze tab, I now get the opportunity to see where the risk and reward lies for this particular trade. So as I can see, the prices are running across the bottom of the graph. So as prices move up, you can see that that creates a losing position for me. But as prices move down, you can see where my profit and loss is going to be. You'll notice there's two lines on the chart. We've got this pink line that is showing the risk and reward at expiration, and then we've got this orange line that is risk and reward as of today's date. You have the ability to actually customize what we're seeing here as well. We can go ahead and add in new dates so we can track the risk and reward over time. And what makes it even a little bit more functional, if we want to bring in a little bit of theoretical pricing, up at the top of the risk profile, you can make some implied volatility adjustments. With earnings coming up, we know there's probably going to be a vol crush after earnings, so I can factor that in ahead of time so I can plan for that, and I can actually put in price expectations, tough word there, but I can go ahead and make those adjustments. All right, one last thing to show about the risk profile. We're looking right now at my debit spread. I can go ahead and check that off. I had planned a few additional positions earlier, so what's really cool about this, I can actually save kind of trading ideas and get them on the screen and layer them in together so I can see where my risk lies across either planned positions or actual positions in my portfolio. So it's a pretty useful tool that I think traders will really like if they put it into their kind of into their toolkit, if you will.
There's some interesting stuff there. If there's a stock you at home want to see our debaters go head to head on, just send us your suggestions. td.activetraderlive@td.com. And for more information about the Active Trader platform, including information about more complex trading ideas and theories, you can scan that QR code that's on the bottom left-hand side of your screen. All right, before we wrap up, gentlemen, we only meet once a week. Obviously, a lot happened since the last time we met into this show. What's on your radar for the rest of this trading week?
So we got some macro data coming out, of course, CPI and PPI, consumer producer index, and then the producer index, I should say. So those are going to be good numbers to look at. Again, that's the leading gauge that what the Fed will look at there to just see how inflation is shaping up on both those contexts. So we'll see those numbers coming out. And then other than that, you mentioned Home Depot as well, Greg. You know, the tariffs are going to place some weighting on it, and it's not so much China, but what's going to happen to us over here, one of their biggest trading partners, and then south of the border across in the U.S., and see if that's going to have a material impact over its business. But we'll see what their guidance is coming out when they do report.
Macro stuff, obviously inflation has dominated, but we're in the thick of earnings season. We were just talking about Home Depot there. Netflix on deck.
Yeah, well, Netflix has already reported, but
they report?
I think we're earlier in October, based on what we've got here in the platform. They had a quite nice bump off earnings actually, and they've actually broken through $800. So they've been trending upwards. So well above support. Really interested to see where that's going to play through over the next number of days. So that's Netflix. Another one that I'm kind of keeping an eye on is a big name, NVIDIA, right? They're coming up with earnings next week, okay? They've been on quite the tear since they did their split earlier in the summer, I believe is when that took place. Really looking to see if that can continue. They had a bit of a pullback over the last couple sessions late last week towards a kind of an established support point. So curious to see if we'll get that rally heading into earnings or if we'll take a bit of a sideways approach as time rolls on.
All right, here's where I got turned around on Netflix. Actually, they came out today with just a little nugget of information for us outside of their earnings cycle. They're saying that the ad-supported tier that they put in there, they now have 70 million global monthly users. So they're giving us just a little taste of what's to come later on when they finally report.
A little drip to kind of
always love those nuggets.
They say people are signing up. Well, that was great, guys. My only regret is that we have to wait a whole week to do it again.
All right, mine too.
Lots of fun.
All right, that's our show for this week. As always, investors should perform their own due diligence and ensure any investment decisions they make fit within the framework of their own investment objectives, time horizons, and risk tolerances. Thanks for watching.